questions in from Hamid as usual. Evgeny, I figured I would just start with yours first here. If y'all have any other questions, you can email them while we're in the class. But the whole point of class is just to answer questions today, and then everyone else will have to just listen to the recording. So let me go ahead and unlock your mic, Evgeny. So regarding extracting triangles, you should just forget the term completely. It was only created because I couldn't understand what was going on with triangles at the time. The only thing that differentiates triangles is which wave is the longest. If wave A is the longest, it's a contracting. If wave C is the longest, it's a neutral. If wave E is the longest, it's an expanding. That's the most important thing. Everything else is irrelevant. As far as the B and the D, they're always going to alternate. They're always going to overlap. And so the type of triangle is determined by which wave is the longest, not by how it channels and not by the behavior of wave B or D. Does that answer that question?
Yes, Glenn. So I wonder, now and then I've witnessed this contracting triangle with what I thought was longest C wave, which you describe in your book.
No, that would be a neutral triangle. If wave C is the longest, it would be a neutral triangle. Wave A would still be typically violent. It doesn't have to be in a neutral triangle, but it usually is. And B and D still have to alternate, and they still have to overlap. And you're not going to have extreme alternation in a triangle. You only have that in terminal patterns. So it would be relatively standard. Will take more time, will take less time, will want to be more complicated, one's less complicated, one retraces more, one retraces less, and so forth. But it's whatever way is the longest, that determines the kind of triangle.
Okay, but wave D doesn't have to be the longest wave, does it?
It has nothing to do with wave D. Ignore wave D, ignore wave B. It has nothing to do with that.
Okay.
It has only to do with A, C, and E. Which wave is the longest? The other two have to alternate. And that's it.
Okay, thank you.
If wave B, of course, is 200% of wave A, well, then you're not dealing with a triangle. You have to make sure that you're in the realm of possible triangular behavior, which means it's probably 138% on the maximum side, 61% on the minimum side. So they have to be relatively similar because triangles are not designed by dramatic up or down movement. They're mostly sideways movement, right?
Yes, exactly.
Okay, so it has nothing to do with the B and the D wave at all.
Okay, that's clear. Thank you. And
okay,
the last question is
all
about
the questions here, or did you want to ask about volume?
Yeah, about volume. It's not about triangles, but generally.
No, not really, because everything's relative. It depends on, I never use it, but if you're going to use it, you better make sure you're controlling the complexity of the chart. If you're looking at a daily chart that takes years, then the volume will be of no use because it's not going to show how much volume occurred on a weekly or monthly basis. If you're dealing with a monthly chart, then you make sure you're controlling the complexity there. And then maybe it would be of some use, but I never used it and I've never found any good use for it.
Yeah, thank you very much, Glenn. That's clear. Yeah.
Okay, so I'm gonna go ahead and delete this email.
Sure, thank you.
Okay, so go ahead and put I'll take now Hamid. I mean, yeah, you can see you have like 90% of all the questions. So I don't know if we've already answered this old one. This is back January 5th. Did we already cover this, or should we just skip it and go on to something more new?
Let me just check. Yeah, I think we can ignore.
Okay, so let's move on to a more current Bitcoin chart. Yeah. This is from the 13th. Did we talk about this last time?
Yeah, this is where we said that, the last pattern is terminal pattern. And I just wanted to
right. Okay, so that was a really good count. I think you had sent that to me again, also more up to date, I think. Did you?
Yeah, the terminal. Well, the high from 20,000. I've done the chart for that.
Well, this doesn't show that, right? This just shows from the low up, and that's it.
I'm sure I've sent you.
I'm going to keep this one for later because it's might be a useful count for me to work on my own service.
Right. I'm going to just send you this now.
Okay, let's go through questions though. That's more actual applications. Let's go through actual questions. Can E be larger than previous leg in contracting triangle? The E wave can be larger than the D wave as long as it's shorter than the C wave. Remember, it's not an issue about what B and D do. It's an issue of what A, C, and E do. The A has to be the biggest. The E would need to be about 61% of wave A, probably 95% of the time. And the E wave just can't be longer than wave E. It should be at least one tick shorter. So that's a contracting triangle structure. What B and D do, as long as they alternate, as long as they overlap, and the behavior afterward has the thrust of a typical contracting triangle, then it doesn't matter if B is smaller or D is smaller. It doesn't matter what it channels like. As long as it follows those rules, it would qualify as a contracting triangle.
Right, so B and D always have to alternate.
Yes, they have to alternate, but in rare occasions, the B might be smaller, like way smaller than wave A. So then the D wave would have to be comfortably bigger than wave C. But as long as they alternate and overlap, it's the type of triangles depending on how A, C, and E look in relation to each other.
Right. Can you get E wave that doesn't go below wave C?
Oh yeah, the E wave, as long as it's shorter than wave C, it could break the C wave low. It may not break the C wave low or high, depending on which direction it's going. As long as it's shorter than wave C and the B and the D alternate, and the A wave is the largest, and it has to be comfortably larger, not just a few ticks larger. It has to be 161% bigger than the other waves or more. It can't be anything less than that. Otherwise, I don't think you have a contracting triangle.
Right. Is 161% the minimum that they have to be large by?
Well, I would look at wave A first, and then you want wave C to be 61% of that. The C wave might be less than 61% on rare occasions, but if it's not 61%, you're probably dealing with something else. The probabilities of it being Fibonacci related to wave A are super high. Otherwise, you're probably dealing with, some other kind of pattern.
Right. Okay.
Okay.
Just a quick one in regards to an expanding triangle. Does wave E has to surpass the low of C in an expanding triangle?
Again, it's an issue of which wave is the longest. Wave A would need to be the shortest, C would be next, E would have to be the longest.
Right.
And you don't want it to be a few ticks longer. You want it to be comfortably longer than wave E, wave C. Preferably 161% of wave A at the minimum. It could be 161% of wave C. It can even be a little bit larger than that, but it's not an issue of whether it breaks the high or low of the start of wave D. It's an issue of, is it larger than wave C? Is it comfortably larger than wave C so that it qualifies as an extended kind of wave in a triangle?
Right, okay.
You want B and D to alternate. And again, you can have reverse alternation in a contracting triangle. You can have it in a neutral triangle, and you can have it in an expanding triangle. So reverse alternation in expanding triangle would mean wave B is wave B is bigger than wave A, and wave D is a lot smaller than wave C. In that case, it would look a little strange, but as long as the B and D alternate, they overlap, there's not extreme alternation, but just typical alternation. Extreme means, one might be 90%, one's 10%. That's too much alternation. For a triangle, it can happen in terminals, it can't happen in triangles. So, one might be 61, might be 38, one might be 70, one might be 30, but when you start getting into the 10 and 90% range, to allow for a triangle, something else is going on.
Right, okay.
Okay, so moving on to this, when projecting time for impulse waves, do you measure the 1 and 3 to project? Yes, you can use the time. There's multiple ways to do it, because when you're in a 5-wave move, you have 3 and 4 to add together to potentially divide by 2. You have 3 and 4 that they're the same, might equal wave 5. You have 1 and 3 to work with to project wave 5. You can't use 2 and 4 to project wave 5, but you can use 3 and 4 and 1 and 3. So if 1 and 3 are about the same, 5 will be longer or shorter. If 3 and 4 are the same, 5 will be equal generally to 3 plus 4. If 3 and 4 are very different, 5 will be equal to 3 plus 4 divided by 2. If 1 and 3 are very different, 5 will be equal to 1 plus 3 divided by 2 in time. So all those statements are based on time.
Do you try and work out the 161% of the previous wave, or do you have to count the impulse waves? For example, wave 1 and 3 to project wave 5, as opposed to say the length of wave 3 times by 161% to project wave 5.
The most likely is going to be wave 5. It will depend on what kind of pattern you're in, but if the first wave is the longest, wave 5 just has to be at least 1 tick shorter than wave 3. If wave 3 is the longest, and wave 1 and 5 are probably going to be equal in price or related by 61%.
Sorry,
one's bigger, one's smaller.
Sorry, Glenn. I meant time-wise.
Oh, time-wise.
Yeah.
Well, that's the whole thing I just ran through a minute ago. That was all about time.
Right. But do you ignore the 161% time-wise? Is there such thing as time? Are you going to measure it?
Yeah, I really don't pay attention to Fibonacci time. It just doesn't seem to have much use.
Right. Okay.
Okay.
Yeah.
Okay, so moving on to number 3. Since many corrections take 100% of the prior impulsion, I can't say that that's true. Is it better to go with? Yeah, I really wouldn't work with any kind of requirements of time from one wave to the next. Remember, trying to do anything between 1 and 2, 3 and 4, 2 and 3, 4 and 5 is really not going to be that useful. You want to make sure that 2 takes the same amount of time as 1 or more, 4 takes the same amount of time as 3 or more, and that it's not likely to be more than 3 times wave 3 or 3 times wave 1. So those are the minimum, maximum, typical limits for 2 and 4.
Right.
And once you have all that, then it's fairly easy to predict the ideal time and price for wave 5, because you'll have 3 and 4 to look at, you'll have 1 and 3 to look at, you'll have the length of wave 1 and the length of wave 3 to try to predict wave 5 using Fibonacci, and depending on which wave is the longest, you should know which relationship to use. So again, if 1 is the longest, then 5 just has to be shorter than 3, but no less than about 61. It could be 38, super rare, but usually it'll be 61% in that case. At a minimum, the 3 is the longest, and 1 and 5 will be equal or related by 61% either direction. And if the fifth wave is the longest, then it has to be longer than wave 3, and it usually will be at least 161% of wave 1. It could be 161% of wave 3 or a little bit more. That's in price.
Right. Okay.
Okay, in an expanding triangle, does wave D, yes, it has to overlap wave B to qualify as an expanding triangle. So if what you see looks like an expanding triangle, but there's no overlap, then you're dealing with a diametric.
Right. Okay.
You're not going to get just a D and an E, you'll get an F and a G.
Right. Can you get diametrics in the terminal impulse?
Yes. Diametric is a correction, so it can occur technically as any wave of a terminal, but if you see wave 2 as a diametric, your chart is way too complicated.
Right. Okay. Okay.
Okay. And your question is, if a triangle is contracting, its last leg frequently contracts. Neutral triangles forming the C wave or the E wave is trying to. Okay. Expanding triangles. Yes, those are all true.
Right. Okay.
And number 6, in your question, can wave E still close above a bottom wave? As long as it's shorter than wave C in a contracting triangle and longer than wave C in an expanding triangle, there's no requirement in a neutral triangle.
Right. Okay.
The rally up 2009's low must be at some point retrace 61% for bull market, right? Why retrace to 61 specifically? No, that's more. Because generally corrections are going to be retraced at least 61%. That's one of the criteria that creates a correction. So it helps to confirm that it is. So remember, you're starting from the conclusion of wave C, not from the bottom of wave C. So where wave C concluded, from that point up to whatever high we make, 61% of that is very likely to be the minimum downside movement when the bear market starts.
Right. Okay.
Okay. I'm not sure what this is about here.
To be honest, I can't remember.
Okay. So going on to number 8. Market wants to form a flat. There can be great variance between waves A and B and C and time. Yes, and flats have the greatest time differentiation between A, B, and C. Triangles would be next, diametrics next, and symmetricals, it's almost all the same. Wave A, can I take 1 day wave C? That's right. So that's all correct. If your B wave takes 6 times the time of wave A, most likely your chart's too complicated. You want to simplify and go to a higher time frame. Okay.
Right, but what I'm just trying to figure out if it's, you know, on a small, or if it's a small degree pattern where wave A takes a day and B takes 6 days. And
Okay, well, remember, it's not a matter of degree, it's a matter of complexity. Complexity is the thing you constantly have to manage to get good wave analysis. Chart's too complicated, you're not going to be able to produce a good count. If it's too simple, you can't produce a good count. It has to be between that 13 to 55. 13 to 34 is really probably better, but 13 to 55 mono waves on your chart. Beyond that, either direction is not good.
Right, okay.
Okay. As generally speaking, let's see. An expanding triangle wave E can be a neutral or expanding triangle. Yes, and a contracting triangle wave can be contracting a neutral triangle. Yes. And a neutral triangle could be contracting. Yeah, I guess so. I don't think I've ever seen an expanding triangle for wave C of a neutral triangle, but I guess it's possible as long as you're not completely contrary to the overall bias of the bigger pattern. So that's the idea there. You don't want contraction at the end of expansion or expansion at the end of a contraction, but a neutral pattern leaves it more open.
Right, okay.
Okay, next question. If the move after wave G is a lot larger and faster than waves B, D, and E, and F, the next wave is probably forming. If the move after is not larger and faster. Oh, I see what you're saying. So you're saying after the diametric is over, if you don't get a move as big as the most recent counter trend move, so in this case, wave F would be the most important wave to look at first.
Yeah.
Then yes, you're probably getting an X wave after the diametric.
Right, okay.
And if you get a bigger move, and especially if you retrace 61% of it, then most likely the diametric will just be one wave of a bigger pattern, like wave A of a flat or something like that. But again, if your complexity is getting that high, your chart's too complicated. You never want a diametric to be one wave of anything because then your chart's too complicated.
Right. Say you get a zigzag. Say you get a zigzag down, and then you get a move up that is not as big or faster than the previous counter trend move in zigzag. Would that then be still considered an X wave?
Yes, after you get a zigzag, if all the rules of the zigzag are followed and you get at least phase 1 confirmation where you break the trend line, you may not completely retrace wave C, but you at least break the trend line in the same amount of time or less, same complexity as less as wave C, and it retraces less than 61%, then that's almost guaranteed to be an X wave.
Right, okay.
And then the final question, NRT or any wave, NRT or neo wave trading, which is better? Oh, absolutely. NRT is better for trading and neo wave is better for forecasting. Trading, it took me 35 years to, I probably began to realize that trading and forecasting were totally different around 15 or 20 years in the business of trying to perfect wave theory. And I kept getting better at prediction, but my trading was progressing much slower than my ability to predict. And I started getting really irritated by that. Like, what in the world's going on? Why can't I make a lot of money trading when my forecasts are good? And that's when I started to realize that trading was a totally different endeavor. It requires all kinds of things, money management and risk management and, timing and all kinds of things that are outside of the realm of just forecasting. And forecasting can get in the way of good trading because if you're focusing on a forecast, you'll forget about the risk. You'll look at, oh, I'm going to make, $10,000 or I'm going to double my money off of this trade. And you keep looking at what the forecast is and you're forgetting that the market's going against you. You're forgetting about the possibility of how much money you can lose. And then if it does go against you, then all of a sudden you've lost a lot of money. You don't know what to do. And you might keep looking at your forecast and saying, well, it's going to turn around. It's going to get better. That's what the forecast says, and just keeps getting worse. So when it comes to trading, the most important thing is to learn to accept you're wrong and have a point of exit. So you lose a certain percent of the money you invested and you start getting out. And for me, if it's in options, 20% loss, I start scaling out. 25%, that 20% I scale out of a third, 25 a half of whatever is remaining. and 30% I get out of everything.
Right.
That's because options are leveraged and you have a much greater chance of making a lot more money. With stocks, they're not leveraged, so you need to start scaling out about halfway. So at 10%, 12.5%, and 15%, a third, a half, and all. And that's what you just have to do, because you have to realize that a forecast is a forecast. It may or may not be correct. And if you trade as if it's for sure going to be correct, you're probably just going to keep losing money on those trades and lose all your money eventually on those trades. So it's a matter of accepting you're wrong and having a point where you just say, that's it, I'm getting out. And if you're one of those who have taken my trading class, in TradeStation I have actual Excel macros that my programmer has written that allows you to download sort of a data dump from your trades right into Excel, and it tells you exactly which trades are making too much, losing too much, what you should do about it to make sure you're always keeping a 3-to-1 profit to loss ratio. Because if you don't do that, over the long term, you're going to lose money. So trading and forecasting are very different. And Neely River theory is all about how to trade. And first of all, it starts on how to scan through, using at least TradeStation, how to scan through 8,600 stocks and ETFs that are available in America and figuring out which ones are viable, and then testing those for safety and potential, which would be step 2, and then figuring out how much you should risk based on the position that market is in the river. If you're in the very early stages, you can risk more. If you're in the middle stages, risk less, around 2%. If you're in the late stages, risk 1%. And then you have the timing, which is what NRT is all about. It tells you what is the best time to enter, and the kind of strategy you should use based on, again, where you are in the river, whether it should be a naked long position, a spread, or a protected kind of position with married puts, or what are called strangles. So it gives you an idea of that. And then once you've taken a position, after you're in, the forecasting, if there was any involved, should completely come to an end. And it should strictly be a money management process, managing those positions that are doing well and scaling out of the profitable positions, partly as they do, double or triple or quadruple the profit of what you spent getting in. And on the other end, you want to start scaling out if they're losing 20% on the options, 25 and 30, and for the stocks, 10, 12.5, and 15. That's the way trading has to be. It's the only way it'll be successful long term. And it's the biggest reason most people don't do well, is because they can't accept that they're wrong. They can't accept their forecasts are wrong. So they let the bad trades run, hoping they'll turn around. And when they have good trades, they get out of them too quickly. And so they ruin this 3-to-1 profit to loss ratio all the time. That make sense?
Yeah, perfect.
Okay, so I'm going to get rid of that. How do we divide the daily high and low in equal parts? Do you understand this now, or you want me to answer it again?
I still don't understand. It comes out in lines. I think I sent you a chart. It's just lines going straight up and
There's
down.
no chart connected to this one. But I can just tell you, if you have, no matter whether the high, let's say you had a market that started off at 0 and went to 100 in one day, and you're doing a daily chart, and the next day it goes, from 100 to 50, and the next day from 75 to 100, and it's a daily chart. It doesn't matter if the high or the low happened in the first minute, the first hour, the last minute. You're going to plot them equally spaced apart. So one day will be divided into 2 parts. And if a day takes 1 inch of space on your chart, the first ½ inch will be the low, the second ½ inch will be the high. If the low came first, the high came first, the first half inch will be the high, the second full inch will be the low. And then the next day you move over another ½ inch and you plot the high or low, whatever came first, and you plot the other one second. So at 2 inches, you would have 2 days plotted equally. Every high and low is equally spaced apart.
But how does that come up on Excel spreadsheet? Because
I can't hear you.
How does that appear? Can you hear me now?
How does that what?
How does that come up on the Excel spreadsheet? Because what you do is when you're plotting a daily chart, you've got, say, 1st of January, then 1st of January, and you plot the highs and the lows.
Let me just show you. I'll just show you exactly how it works. There's a weekly chart on the S&P. They have to be vertically plotted one after the next. So here is the data. Oh, sorry. Here is the week of the 20th, the 20th. Here's the high coming first for the week, the low came second. Previous week, the high came first, low came second. So you have to have the dates vertical, price vertical, and when you do that, it plots it out like that.
What about the daily chart? I know I can do the weekly chart. It's the daily chart that I'm struggling with.
You can't do them. You can't have high, low, high, low. It has to be vertically spaced so that it's a continuous string of data.
Let me just send this to you.
So it's done exactly the same way the weekly chart is done. You get the high and the low for the day. You figure out which came first. Our systems do that because Stefan keeps track of the cash price action all through the day, and it's maintained on the internet, and then it's downloaded from the internet right into the document. I haven't opened this in a while, so it's going to take a minute for it to update, but it's done exactly the same way as the weekly. Every single data point is vertically spaced one after the next, and so it's exactly the same way the weekly chart was done. Not sure how far up this went. Okay, so there you have the 16th. The low came first, high came second. 19th, high came first, low came second.
That's exactly what I've done. That's exactly what I've done. But my chart is showing straight up and down lines. But it is progressing with time.
You need to make sure it's the right kind of chart.
Yeah, it's a line chart. I forwarded you.
Yeah, but there's different types of line charts.
It's a line chart that I've used for the weekly data that I've sent.
I had this problem with Stefan recently. I can't remember. It has to be a text chart or something like that. Because I ran into this problem. I said, your chart looks all funny, and I didn't know why it looked all funny. And he says, you have to change it to a certain type of chart. Chart series. Let me see if I can find the email that I got from Stefan about this.
Yeah.
Okay, the 6 lines requires manage.
The chart that I've sent you, they've all been fine, you see. And it's just this daily chart that's causing an issue.
Create an evenly spaced x-axis. Double click on the x-axis. I'm going to forward to this email. So let's see. What does your email address start with?
It's H-A.
H-H?
H-A-M-I-D.
Okay. Is it a Hotmail account?
Yeah. Yeah.
Okay, so I'm sending that to you right now.
You
can see the chart that's attached, and he tells you how to do. He says you have to click on the axis, I guess the x-axis, and select text. Okay, so let's go. You have to click here. Yeah. Well, anyway, I sent you the email about it, so.
Yeah, thanks for that. I'll read it through.
Okay. Okay, so move on to the next thing. Close my. Okay, go ahead and put your mic on mute for a second here. I have to reopen my email. Okay, so this, we took care of that. Let's see, is Ray in the class right now? No. Duong is in the class. Nope. Let me go through Duong's question here. Would look forward to your first copy. Do we call things from manage? He's just asking for some analysis question. I'll open up real quick and see if it's relevant. Yeah, that's not that. This chart is too simple. See if you would actually count the monoways 1, 2, 3, 4, 5, 6. I mean, it's probably barely 13. It's probably even less than 13. And starting from the high, it's definitely less than 13. So it's too simple, and it's a bar chart. It shouldn't be a bar chart. It needs to be a wave chart. Let's see what this looks like. Same problem. Your chart's too simple, Duong. So you need to get out of the bar chart stuff, and you need to show the highs and lows in the order in which they occurred, space them equally apart in time. So for this chart, if the high happened first, it would be here. And if the low happened second, it would be here. And the next day, if the high happened first, it'd be there, and the low would be here, and the high would be there, and the low would be there, and so forth. Just make sure they're plotted in the order they occurred. Okay, so let me go ahead and get rid of that. Ray has a count. This is important because these are the kind of mistakes people make all the time. So you can see wave 1 takes way more time than wave 2, so there's no way that count's correct. This could be an A and a B maybe of a neutral triangle or diametric, but it can't be 1 and 2 of a zig of an impulsive pattern. It can't be A and B of a flat. It can't be A and B of a zigzag. So this count is not possible. Okay, so let me get rid of that. Said you had another chart I want to go through. Okay. So let's open this, and then I'm going to open it up for, actually, Michael has a question. Let's see what Michael has a question. Wave Fib Trader at Gmail. So Michael, that's Richie. What is that? That's Richie. So let me see. Did you have a question, Rich? Let's see. Okay, so hi Glenn, can you also forward to me, please? Okay, so give me 1 second. I need to send Richie that email. Okay, so that was wavefibtrader@gmail. Okay, so I'm sending that to you also. And then let's see, if somebody else wanted that. So I took care of that for Richie. And then I guess I'm just, okay, fine. So Evgeny, did you also want me to forward that email that I got from Stefan regarding fixing the plotting of charts? Just type it out in the question section.
Yeah.
Okay.
Yeah, if
Okay,
possible.
yeah,
thank you.
You what?
Well, if you will, then I'll be very grateful. Yeah.
Okay, so I'm doing that right now. Okay, and let's see. I took care of that. So I guess how much should adjust? Okay, yeah, so we took care of that. And then Michael has quite a few questions, and I'll get to those in a second. Richie says, I have another question in stock as prices started. Do we start analysis from zeros? Okay, so Richie, you want to go ahead and unlock your mic? It looks like it's unlocked now. So can you ask your question?
Yeah, sure. Can you hear me, please?
Yes.
Okay, great. I do Indian stock, and prices start sometime at around one particular price, say for example 120 rupees or whatever.
Right.
There is when an IPO comes in, the prices starts from 120, and then it goes up and up and up, all that. However,
right.
Do we start the analysis, the first mono wave from 0 to 100? And so first one.
Well, I mean, only if you have the data. I'm not sure how you would get it if it wasn't being traded on the market at that point.
No, there is no data, and the prices
Yeah.
do start from 100 only, say for example.
Yeah, okay, so if there's no data, then you're just gonna have to start with the data you have, and your goal in that situation is to look for the first violent move down or up that it's more bonds and bigger than anything else to indicate you started a new pattern and a new trend, and that's where you would begin your analysis. Until then, it's going to be very difficult to have any idea what's going on.
Got it. Okay, fine.
Okay.
Yeah.
Okay, and then Michael has quite a few questions here. Let me try to get them in order. Okay, wait, let me deal with Wilton because he was the first on the list. So Wilton says, is there a specific site that you can download data for highs and lows from, or do you advise to do it manually? I don't know where Stefan is getting the data. I know he searched on the internet for good cache data sources, and I think that he's using those. I don't know what they are specifically. And he has to write programming to properly access it. So most likely you would have to do it manually, but you definitely want cache data. Stock is easy because stock is always cache data, but for futures markets, you really want to use cache data for cache gold, cache silver to do wave analysis. If you want to write Stefan, you can do that. I'm not sure if he'll tell you where we get our data from or not, but it shouldn't be that hard to find cache data. Just don't use futures data to do wave analysis because it deteriorates with time and it eventually expires and you have to keep starting your charts over. And for wave analysis, the biggest mistake almost everyone makes is they want to take the easy route and just do a bar chart, but that's just not the best way to do wave analysis. Okay, so let me see. I'm going to unlock your mic, Wilton, real quick, see if you wanted to ask any other question here.
Hello?
Yes.
Hello, can you hear me?
Yes.
Yes, I had a question about NRT.
Okay.
And also New Wave. I wanted to know if let's say you know New Wave only, and you only know NRT. Which one do you think is the best kind of strategy to?
If your goal is to make money trading, definitely river theory is the way to go. If you're hired by some company to make forecast of a market and its direction and maybe the real estate market, the stock market in general, but you're not actually trading, then wave theory would be better. So it depends on what you're actually doing, but most people of course prefer to make money trading, and that's doing it for their own account. They're not in a position where they're forecasting for a living for some company. So if your goal is to make money trading, wave theory is river theory is definitely the way to go.
All right.
So did I answer that question?
Yes, it did. Thank you.
Okay. Okay, so go ahead and put your mic on mute. Let me get to Michael's questions. He has several here. Okay, so Michael, your first one says, does NRT make any use of wave analysis at all? Yeah, I really don't use it. The only time I'm going to use wave analysis for my trading is when the structure is extremely clear. Remember, it's sort of like if you imagine you're in a river where the market's like a river flowing and moving around. If you're in a river and you're in a boat, just think of how ridiculous it is. At every turn in the river, you're trying to predict when you're going to reach the ocean or reach the lake. I mean, what's the point? Just ride it until it gets there. So with markets, they spend 90, 95, 99% of the time between the top and the bottom. So as long as you learn how to get in on reactions between the movement from the top to the bottom or vice versa, that's where you're going to make most of your money. You're not going to make most of your money by getting in very at the top or right at the bottom and hoping, of course, that you're in at the top or the bottom, because most of the time it turns out not to be the top or the bottom because they only happen, one day for a few minutes and that's it. So it's a real waste of time. All professional traders will tell you make money from the trends, but you don't want to buy, in after it's been going on for a long time right into highs. You generally want to buy as early on as possible after the trend is established, using concepts that I go through in my trading classes and learning how to get in on reactions that are safe and how to control risk and how to manage your positions once you're in. There's a lot to it. It's a lot more involved from a different perspective. Wave theory is complicated from an intellectual, logical perspective. Trading is more emotional management, risk management, profit loss management. So it's a different kind of thing. So I would definitely pick NRT for sure. And, there's a good chance over time that my company is going to be more and more solely focused on river theory because my long-term goal is just to manage lots of money. And so I'm slowly, moving in that direction. And for those of you who've been with me for a long time, you've noticed how I've gone from strictly forecasting to trading forecasting to now the trading service has no forecasting and the forecasting service has no trading. So that they've been completely separated now because I realize they're totally different things. Okay, you also had a question here. Michael says, for example, would it scan for specific patterns on charts where a pattern might, what's that question about scanning patterns?
Yeah, so it's kind of relating to the first question. So is it using wave analysis at all? I mean, you mentioned
No.
you want specific, for
No.
example, at the end of the pattern when it becomes the most clear. Is that part of it at all or not at all?
Yeah, I would say wave theory is mostly useful. Like, for example, wave theory has been critically useful to me at the high in 1987, where I avoided the crash, the low in 1988, 89, when I stopped being bearish, the peak in 2000, where I turned long-term bearish, the low in 2002, where I turned bullish for about 5 years, the peak in 2008, where I turned bearish. After that, the low in 2009, for the last quite a few years, it's been very difficult to figure out what's going on with wave structure and stuff. But those are the critical major points that saved me from being invested at, being long when the market was going down for years and being short when it was going up for years. So at crucial turning points, that's when wave theory is the best. It'll help you to predict and understand that you're reaching a critical turning point and that being heavily long or short becomes very dangerous at those times. So it can save you, like, for example, I took over my mother's portfolio in September of 2000, and that was the actual day that the bear market started. I had took her a while to get all of her stuff together, and I was like pushing her along as fast as I could because I was telling her if she didn't do something, she was going to lose about half of her stock portfolio's value, because I knew we were getting ready for a pretty major bear market after the high in 2000. So the day of September 5th, 2000 was the day we were in a brokerage office transferring all this stuff and getting ready. And I, told the broker that I wanted to immediately go short the S&P to protect her stock portfolio, an equal amount of short S&P equal to her stock portfolio. So that way she wouldn't lose any money during the bear market. She actually ended up making like 50% during that decline. But that's where wave theory is crucially valuable, is at the extremes. The rest of the time, it's almost a distraction and can be detrimental, because when you're not at the beginning or the end, you may think you know what's going on, but a lot of times you're wrong when it's not at the beginning or the end. It's at the beginning and the end where your confidence can be very high, but the entire world thinks you're wrong. And during the middle is when everyone wants your opinion and you're least likely to be right. So wave theory is only good at the extremes, and that's when I would be using it. I think we're getting fairly close to a critical point in the S&P. So sometime in the next month or two, there might be a point where I think it's just too risky to be long the stock market anymore, and I'm going to get out of almost everything. But it hasn't happened for a really long time, and I'm still waiting for that to happen.
Any way to find those, or to find markets with those extremes? Is NRT doing that at all?
I don't use wave theory to find markets to trade, because it just takes too much time to go through the process. And again, major tops and bottoms happen, very, very infrequently. That's why they're major tops and bottoms. So you want to just work with processes that help to identify that a market's topped or bottomed and you've started a trend in the other direction, and you want to get in as early on that trend as you can in using processes and methods and risk control that makes sense. That's what the river trading class is all about. Your next question was, so does NRT include maintenance of yes, absolutely. I could give you an idea that I guess y'all have never seen that before. Y'all can see my screen right now?
Yes.
Okay, so these are actual real positions in the customer account. I'm not sure if you can see customer account written up here. I'm not sure what y'all can see. You may just see Option Stations Pro, but these are all the real world customer account positions that we currently have. Shows how much money we've spent on our open positions, how much we're up, how much we're making on the $34,000 being spent. And this is an export function built into TradeStation that allows me to export the customer data into an Excel spreadsheet. This is what Stefan wrote for me. And then it takes that information after I've saved that, I don't normally do this in Windows. I do it in on the Mac, so I gotta figure out what to do here. I think it's here, yeah. So then I open up this manage application that Stefan has written for me, and it has these rules built in to keep things at a 3-to-1 profit to loss ratio. Go over here, go into macros. Oop. Again. Should show the macros. Should show it. Let me close it and reopen it. Okay, I'm not sure if I have to change the view of this. Not sure if this is it or not. Let me go to the other one. I never do it on the Windows side, so I'm not sure why it's not showing that macro, but I can show you what it looks like after it's done. If you just give me 1 second. Well, actually, we should have some examples of that. Hold on a second. I'm going to go on my Mac side here to find. Okay, here it is. So this is the most recent one. So it's customer January 16th. Documents. I'm going to have to drag it to the desktop so I can find it easier. Okay. Okay, so this is what the printout looks like after the thing is run. So it'll go through and analyze and separate everything. First thing is it going to expire really soon? That's the most important thing. So as it expires in the next 7 days, it's going to put it at the top no matter what it is. Then it separates all the singles first, because singles are like naked long positions. Those are the most dangerous positions. Option, naked long, or naked long calls, or naked long puts. So it separates them all out. The purple ones are short positions. The white ones are long positions. The red are losing positions. The green are profitable. So here we're making, 75% of our positions that day we're making money. Up 9%, making $3,300 on about $39,000 spent. And then it puts the equity position second, because that's the second most risky. Verticals are the second least risky, and then covered calls and married puts would be the least risky of all. I don't have any of those, but that's how it lays it out, and then it shows you what you should be doing. In this case, it's saying to either exit this position or roll because it's getting ready to expire. It's making 92% of its maximum potential. And it organizes them in the list by the least profitable to the most profitable in each section, least profitable to most profitable. So I know which ones to focus on. You always want to focus on the top 3 most profitable and the bottom 3 least profitable in each category. The rest of them you pretty much ignore, because if it's not making a lot or losing a lot, you just need to give it more time to either move in your favor or go against you. A big part of trading is just giving things time to make money. And if you don't give it enough time, it's going to be very hard to make money. So that's a crucial part of the process. I can show you all some examples of how I actually go through the testing process. So here's a scanner that runs every day automatically, and it goes through 8,600 stocks and ETFs in the US, and it starts to map out stocks that show early accumulation, which has to do with volume analysis. Those that are past the accumulation phase, and it's going through, I'm not sure why that didn't run, going through the trending phase. Markets generally go from accumulation, which is the early phase of a new trend. Then the trending phase, where moving averages start to work. The accumulation phase is mostly based on volume activity. Then you move into the momentum phase, where after you've had the accumulation and after it's been trending for a while, the public begins to find out, the media starts talking about it, and all of a sudden everybody gets excited, and you go into a momentum phase toward the end. and then it goes back into a trending phase or back to accumulation. And if it's a top, then it's going to start going through distribution, and then it trends downward, and then it has acceleration downward. So it actually goes through and searches based on criteria I've been developing for, I mean, decades of work has gone into all this. But it does the scan, it gives me a list, and then from that list, I can decide the next step. Like here's DIA. This is showing everything in blue because for some reason it didn't run yesterday, so everything is new, but normally there'll only be a few blues in the entire list. Let me see if I can find one. All these scans didn't run properly. Maybe I had the program closed. Like here is just one listed. So it'll just show me the most recent stuff that recently changed conditions. So then I take that stock, I just copy it, and I paste it onto this page. And this is the first thing I want to test to see, is a stock in a safe position to make money currently according to the evidence. You know, it might be in the early accumulation phase. This one isn't, but let's just say that it is. So it'll show me based on this chart, this is again based on river theory, not based on wave theory, whether we're in an acceleration zone or a congestion zone. This is not a good example, so let me use the S&P. Okay, so here's a standard river channel, which is based on using information from larger time frames, and the system automatically calculates 6 monthly charts and creates channels on that chart and places it on the monthly time frame to create the river environment, because smaller time frames are at the mercy of larger time frames. So as a smaller time frame approaches the channel that is visible in a larger time frame, that's when the big traders start coming in, and the money they have is more substantial than the money that the people have on the current time frame. So if this were say a daily chart, then this channel would relate to where weekly traders are taking action. In between, they're not doing very much. If it's a weekly chart, then this is a monthly channel. If it's a monthly chart, it's a 6 monthly channel, and so forth. So the channel has relevance when you're near the extreme, because that's when the bigger traders with more money start coming in and causing trouble for the people with less money on this time frame. So you can see multiple times, let me close this window here, multiple times the market reached right into the channel and then went through a big reaction, reached into the channel, a really big reaction, reached into the channel reaction, and now we're moving above it. It's possible it could keep going, but we're still in a relatively, this is a high risk situation. So from a trading standpoint, if you were going to take any longer term positions, the only safe kind of trade would be a strangle or a Mary put, where you're long the stock and you have a put also. So in case it collapses, it's not going to hurt you. If it goes up, you'll make money. Your put will lose, but it won't lose as quickly as you'll make money on your other side. So this gives an idea of the kind of things that I would do to test a trade. So let me pick something that looks a little bit better than this for trading purposes. Let's see, GLD. Okay, so this looks good. So from a gold perspective and river perspective, it's showing that gold's in the middle of a Neely River channel. And again, this is a 6 monthly channel derived from compiling monthly data and creating 6 monthly charts and then applying rules to that to create a channel that's going to have an impact for monthly traders. So it takes that channel, and you can see there's resistance here and support down here. We're in the middle, so we're in an acceleration zone, which means this market qualifies as a safe environment in which to go long, because there's plenty of potential to go up. The green bar down here means that volume flow is positive. So we're in an uptrend, according to river theory. We're in the acceleration zone and volume agrees with it. So immediately I would write this down. You know, GLD is a possible trading opportunity. So that's step number one. And then down here you see where it shows the risk levels. Shows if you're in the early stages, which means the bottom of the channel, you would want to risk 3%. In the middle, which is where we are, we would risk 2% of capital. If you're in the upper stages, you'd risk 1%. That way you're risking less and less as it gets more and more dangerous. So right now we could risk 2%. So I'd write down GLD 2% risk. The next step, you go to volatility. You want to know how trendy a market is, which indicates how much movement against your position you might experience when getting in. So if you're going to trade options, you want to know, is this an early stage trend where there could be a lot of volatility on a monthly time frame, which means you have to go really deep in the money or just buy stocks. If you have a monthly trend, which is indicated by these green bars here, where volume flow is positive, it reinforces the uptrend, which started right there just a few months after the low. So it reinforces the uptrend, says it's probably a safe, buying environment. And then the weekly trend, which is more like moving averages turning positive and things like this, is what I call my mode index. It's a complex kind of moving average, multi-level kind of moving average, but generally it's still a moving average kind of concept. In any case, we're in an uptrend. So the goal is you want to get in during the reactions of the uptrend. So you can see here it was given a buy signal on the weekly chart. The monthly trend was already up. The weekly trend was up, but it gave a buy signal with a little green dot right there. That was right near the lows. And so you could have gotten in and caught, a great part of this. You could have also considered getting in here. I didn't give a signal, but anytime it's below halfway of the channel, then you can generally get in relatively safe. So right in here was giving some more buy signals, even though it wasn't as significant as this one. And then you get into the momentum phases after that. So after you've maybe bought on a weekly basis, you can go to daily charts and look for daily momentum. Momentum has to do with the market breaking out above highs and lows for a certain period of time. And I've worked on this again. These are all proprietary indicators, but I've worked on them for a long time. Here you can see where it broke out and it started to agree with the monthly trend, which was up, and the weekly trend was up. This is where you begin your momentum phase. See, this is where you can actually buy directly into a new high. You don't have to wait for retracements. When you're dealing with monthly charts, you can buy during declines. Weekly charts, you want to buy on reactions of an established uptrend, and daily charts, you can buy on a breakout because it's an agreement. As long as all these other trends are up, then you can buy on a breakout, and you could have done that here, and you would have caught a really nice move up. So that's the next step, and it tells you what kind of risk to take. So here you have the monthly and the weekly in sync, but not the daily. So you would be wanting to go, if you're trading options, 90% below the 10% below the market, so a 90% price level from where it is now. So you take 147.4 times 0.9 and whatever that is, maybe around 125. That's where you'd have the strike for your call if you're buying it. If you're going long stock, it doesn't matter. But if you're going into a call, you would want to have it 0.9 below the current active price. So it gives the market room to move up and down without you having to worry about placing stops, and it gives it room to breathe. The closer you are to acceleration, the less room you need to breathe. So if it was for the acceleration trade over here, we could have gone 95%. So you take this price and take 95%. So it'd be much closer. So the risk of entry gets less and less as everything gets in sync, and the risk of downside movement gets lower. So that's what that is all about. So this just tells you how far below the market to go for your strike if you're going to go into options. And then that's from a preparation perspective. And then the final thing is actually getting the signal to get in and how long the trade should last. So the signal to get in is based on NRT, and there would have been a signal right here. I think the bar, yeah, see how the bar just turned green? This is because under river theory, there's certain things that you need to see to create an entry. And there's three different types of traders. There's bias traders, which are bargain hunters, those people who get in early on trends. There's the trend followers, which tend to buy on reactions of an established trend. And then you have the momentum traders, or the what I call time traders, but those are the people who are buying breakouts or selling breakdowns. So in a bias environment, you're going to be looking for the other traders to be going short right at the wrong time. So here it shows where the breakout traders would have gone short below this low, the trend traders would have gone short below this low, and they're doing the exact wrong thing at the exact wrong time. So the bar turned green, and on that particular day, you would have had an environment which is safe to go long, the trend is up, and you want to risk about 2%. You have a volatility environment that's saying go 0.9 below the current market price, or around 125 or whatever the strike would be. So that's giving you a strike price for your call or your spread. And then you go to the signal. This would have been the signal on that particular day at that particular time. And because the signal is occurring on a daily chart, you'll notice the monthly is gray and the weekly is gray. The daily is the only active chart. So it's telling you go about 1 month out. So daily charts 1 month, weekly 2 to 3 months, and monthly charts 4 to 6. So if the monthly chart were highlighted, I'd go 4 to 6 months out for options, or just buy stock. Weekly chart were active. I go 2 to 3 months out. If daily is active, 1 month out. So it's telling you to buy a 1 month spread because the bias traders are in charge. This is all sort of complicated. I know I'm going really fast, but so you get a 1 month spread. You would have bought it right there. That turned out to be, I think, the day of the low. Let's see. Yeah, it was the day of the low there, and the market's moved up since. So you'd be making money on your spread because spreads make money as long as the market just goes sideways or it goes up. And if it goes down, your break-even point gets lower and lower every single day for the whole month, for the entire month of duration. So I'm not sure where the break-even would be, but it would be probably somewhere around 25% from the strike, from the current price down to the strike, wherever that was, I think 125. So I'm just gonna have to, maybe around 140 would have been the point where you would have broken even over a period of time, as long as the premiums were high enough. But all that's explained as part of the class, and that gives you an idea of the proper way to go about trading. It has to do with, making sure it's safe to get in, making sure you're risking the right amount, making sure you're, going far enough below the market if you're buying options, and there's all kinds of stuff involved with trading that are not part of forecasting. Can't remember who asked that question, but let's see, whose mic is still open, if anybody.
It's still open, Ben.
Michael. So does that answer? I can't remember what your question was, but I went into quite a bit of detail there.
Very impressive. It's just a pity that it's only limited to TradeStation.
Yeah, unfortunately, because I've spent the last 20 years developing all this. Believe it or not, all this NRT stuff is like over 100,000 lines of code. It's very complicated. It's a lifetime of work has gone into this. Finally, for the first time in my entire life, I feel like I've pretty much solved the mystery of trading. I've figured out all the aspects of trading. I don't need to really spend day and night working on this stuff anymore, so I can relax now. But this was a massive undertaking, just like writing my book was for about 10 years. That project was finished a long time ago, sort of perfecting wave theory. Trading was much more difficult than I ever expected it to be, and it's taken me, 20 years of work to finally perfect pretty much every aspect of trading. So now it's just a sort of a scientific step-by-step process, and it just makes it easy. It's such a relief you can't even imagine. I mean, I finally feel like I can actually relax for the first time in 37 years.
Okay, I got 2 more questions on going back to wave theory. If you look at the questions window. So plotting the charts with the high and low equally spaced apart, is that essential for your time-based rules?
It's absolutely essential for good wave analysis to equally space them apart. If you have a daily chart and you put the low that occurred in the first minute and the high that occurred midday or late in the day, and you have the big space between those two, it makes the charts look very weird, and they won't look like the diagrams in the book, and the rules, just for whatever reason, it doesn't work. I've tried dozens of different ways of plotting charts over the decades, and it just has to be done that way.
And for the retracements rules that you have, how accurate do they have to be? Like, does it have to be exactly like 61.8% or 38.2, or how much deviation is?
Retracement rules are not exact amounts, they're limits. So if the retracement is exactly 61%, then you're left with the dilemma of, is the move before impulsive or corrective? If it's comfortably less than 61, then you can be pretty comfortable it's impulsive. If it's comfortably more than 61, you can be certain it's corrective. It's right at 61 that it becomes a debatable situation. So it's not, you're not looking for perfection. You're looking for that amount to tell you, is it impulsive or is it corrective? And if it's right at that amount, then it becomes dependent on other factors and the structure of the pattern and what happens before and after. So it becomes more difficult to decide. But as long as it's comfortably more or less, then it becomes fairly easy.
Okay, and was it below 38.2% or 33%?
You want it to be about 33% to be an official impulsive pattern, or at least potentially an impulsive pattern. So between 61 and 33%, anywhere in there, you could be dealing with an impulsive advance or decline. If it's less than 33, you're probably dealing with a complex corrective rally or a zigzag followed by an X wave. Impulsive patterns need to be retraced at least 33%, typically, for it to qualify as an impulsive pattern.
Okay, and the upper boundary is really the 61.8.
The maximum retracement for an impulsive advance would be 61%. Beyond that, your probabilities get dramatically less that you're dealing with an impulsive pattern.
Okay. If there's still time to play, I sent you some charts as well.
Let me see if I have any other questions. I don't want to, monopolize it here too much. I want to make sure everybody has a chance. So let's
answered
see.
The questions so far. Thanks.
Okay, so I'll get back around to see your other questions here in a minute. Any Fibonacci relationships for this, please? Like Richie, you're asking a question about Fibonacci relationships. I'm not sure exactly relating to what. Oh, relating to a flat or a triangle? Richie, your mic, you can unmute your own mic if you have a microphone. Okay,
right.
There you go.
Yeah, just as you have identified contracting triangles, that once you see a violent move on wave 1 or A, is there any way to identify contracting flats?
Well, I mean, yeah, a flat is that's not the proper way to call a flat. Flats aren't contracting flats. You could have a strong B wave, a weak B wave, a C failure, a B failure, but you wouldn't consider it contracting flat. So if you have a pattern in which wave A and wave C relate by 61% and B was around 80% of A, then almost for sure you're actually going to get a contracting triangle and not a flat. But if A and B are about the same, you're not going to get a triangle almost ever. You want the B wave to be different than wave A to get a triangle. It can either be a little bit bigger, a little bit smaller, but it shouldn't be equal to wave A. That's almost always going to produce a flat pattern instead of a triangle. So I'm not sure if that answers your question or not.
I'll have to work more on it, to be honest. It's okay.
Okay. Well, in a flat, the C wave and the A wave are far more likely to be equal in price, or very close. In a triangle, they're going to be 61% almost always, in a contracting triangle that is, between A and C. Between A and C of a neutral triangle, the C wave is usually around 138% of wave A. And for an expanding triangle, wave C has to be bigger than wave A, but not more than 161%. And wave E has to be bigger than wave C, and generally at least 161% of wave A. So that would be the rules, Fibonacci-wise, price-wise, for triangles. I would never call something a contracting flat. That's just not using terminology properly.
Okay, got it.
Okay.
Yeah.
And as far as differentiating between flats and triangles, the more violent wave A is, almost the more certain you're going to get a triangle.
Okay, got it.
Okay. Okay, so Michael, you had another question here. Is how accurate do you have to measure a trade? Okay, we already went through that a minute ago. You said, Michael, that you have a chart that you wanted to send me, or that you did send me?
Yeah, send it while the class was ongoing. It's 3 charts actually. It's one with monthly, and one with weekly, and one with daily data.
Okay. Richie, I think I sent you the email, didn't I? I'm pretty sure I did, so I think you got it. If you didn't get the email from Stefan, let me know, but I'm pretty sure you got it. Let's see, I don't see any chart from you. Where did you send it?
Just while the class was ongoing, so you may have to refresh
but which account, which email account?
To the cs@newwave.com.
Oh, okay, yeah, you sent it the wrong one. Hold on.
Which one should I use?
It should be NeoWave and NeoWave. Okay, so let's see. If anybody else sent anything to NeoWave and NeoWave, that's the wrong one. It needs to be. I mean, CS and NeoWave. It has to be NeoWave and NeoWave.
Should I resend, or you pick them up?
I can drag them over.
No problem.
Martin, are you in the class? Yeah, Martin sent it to CS too, so I've got to drag all these over to the right account.
I'm resending to newwave.newwave.com.
Thanks for clarifying that. Let's see, geometry. Looks like some more from Hamid. Let's see, I'm getting all kinds of emails here that were sent to the wrong account. I'm not sure if we're gonna have time to go through all these, but let's see. Send deep. You send deep in this class right now? Nope. Okay, so let me get back to the email. What we got here? I have to move them over. Give me a second.
Glenn, I also just resent them to NeoWave.
Yeah, I know. I'm having to drag them over, so I have to go back to my Mac. I'm on my Macintosh doing all this. They're all sent to the wrong place. Okay. Man, there's a lot of questions. Okay, so what is this relating to in specific before I actually open it up?
Yeah, you can open it up. It's coffee.
So you want me to start with the monthly?
Yep.
I recommend doing your charts. Ooh, that looks very difficult to look at. I'd recommend doing your charts with black background and white bars, or white background and black bars, not any other color, so that you can color code things, you know, like buys and sell signals with red and green and things like that. This chart looks pretty good, even though it's really hard to see. It has the look of, yeah, it has the look of a properly drawn wave chart, so that looks good. Is that your question?
Yeah, and if we could have a where you would start the count, I guess, at the.
I have to zoom in a lot because it's very, very hard to see the chart. Let's see. So let's see. Okay, so the most violent, largest and most violent move on the chart is right here. Okay, and that would be, maybe we got a bigger move over here. It's very, very hard to see. It's a bunch of little dots, but this looks very violent out of the blue. So I would suspect this could be wave A of something because it's completely retraced. This might be wave C of the same pattern, but it looks a little, there's a lot of time difference between these two, so I'm sort of uncomfortable with that. You might be dealing with a diametric pattern possibly. So this might be wave A, wave B, wave C, wave D, wave E, something like that. It would take some time to go through this and make some time measurements, but I do see a lot of time similarity between possibly this move, this one, this one, this one. So the beginning potential, not the beginning, but the sort of the midway potential of a diametric possibly forming with this violent move here. Diametrics are very similar to expanding triangles and contracting triangles. The A wave typically is the most violent. That may be what's going on here. If you draw on some trend lines, we'd probably see some kind of expansion and contraction or vice versa. So it looks like maybe it's contracting first. We'd have a trend line here and here and one here and here. So that'd be the contracting phase. And then the expanding phase would be across here and here. And this would probably continue this way. So it does look like maybe a diametric began with this low right here.
Okay.
Okay, and in diametrics, you can have two waves that are different. That would be this one and probably the G wave over here. So A, B, C, D, E, or the F or G wave. So the expanding phase still has some, way to go, but it looks pretty good. We definitely have three segments that look very similar in time. This might even be an elongated flat possibly there. So that would make this move to here the same time as this move and that move, at least I think. Very similar, yeah. So that would be my first guess. I have no idea what market this is, but remember, you're looking for violent behavior as the start of a new pattern. This is probably the most violent, even though this one's larger, it's a little bit slower. This is the most violent. It happened out of the blue. Lots of dead, slow action. All of a sudden, wham. That suggests something new began with this move, and that would be wave A. If it had not been retraced more than 61%, then it could be wave 1, but it was, so it'd have to be wave A. Okay? Then you would go on after that with your weekly chart. You would take, the diametric pattern, maybe expand it a little bit. It may be a little too complicated. If this is the G wave decline, which really can't see very well, the F wave decline, then the F wave is going to be a corrective pattern, and you would try to work your way through it. If this is, let's see, the first drop. Yeah, so this is less than 61%, so this might be impulsive. This could be wave A, this could be wave B. This doesn't look very impulsive to me. So you might run into some problems there. Can't really say what this is for sure. Excuse me. I'm choking. Choking a little. Let me take a drink of water. Oh, gosh.
So these tiny retracements there, that probably says it's corrective.
Well, it has to be corrective because the bigger picture tells you it's corrective.
Yeah.
So this would be an F-wave decline, which by definition has to be corrective. So you're going to start off with the final structure will be corrective, even if this is impulsive. But I can't really say because there's just not enough information. We're only dealing with like 7 or 8 monowaves. There's just not enough information to be sure what's going on here. So you're just going to have to wait that one out. You might be able to go through some analysis of this, but it doesn't really matter because it's all corrective. So it doesn't really matter. You know, the bottom was here and the top was there. So that would be, you know, wave D and that'd be E and you're in wave F if the larger count was correct. So you're going to use your larger chart to guide the analysis on the small. The data is going to be a complete waste of time because you're not quite sure what's going on the weekly or the monthly for sure. So it's just not going to be productive to go on a daily time frame. So that would be the process I would go through, and you just work your way down. But you want to start with the largest time frame first. And once that's clear and you know which wave you're in, then the last wave on the monthly chart is where you start your weekly chart analysis, and then the last wave on the weekly chart is where you start your daily chart. So you never want to go all the way back to the beginning of time because you're just going to get a chart that's unmanageably complex. You have to control complexity all the time. Okay.
Okay. Thanks, Ben.
Let's see. Wilton. Your mic is now unmuted. Says, what have you guys been? Okay, I think I already went through this.
Yeah, we discussed that one.
Okay, let's go ahead and move on. So you have some other charts here, Mike, or are these the same charts? Looks like the same charts to me. I think those are the same charts. Okay, Hamid, your older questions, I think we may have gone through this. So Hamid, your mic is unmuted now. Did we go through these questions? I guess we didn't.
No, they're the new questions from a few days ago.
Yeah, you don't want the fourth wave of a 5-wave move to overlap the price range between 1's high and 2's lower by, 2's low
Sorry,
and 1's higher.
that's for the terminal pattern. Does wave 4 need to
Yeah,
overlap?
in a terminal, you want wave 2 and 4 to overlap.
Right, okay.
I can't remember, but did you say it's impossible? It's possible to have a double extension. I mean, I don't think I've ever seen it in my entire life. So I would be very, very hesitant. I would only allow the third wave to be 161% of wave 1 or less. I wouldn't allow it to be more than that. If it's more, the third wave should be the extension. So in my opinion, double extensions are basically impossible. I mentioned in the book they should be super rare, but when I wrote the book, I'd never seen them. I figured it maybe was possible, but I now think after 37 years, probably it's not possible.
Right, okay.
Okay. There's a terminal pattern with wave 3 extended. Oh yeah, absolutely. So you should consider a first extension terminal the weakest. A third extension terminal could be not quite as weak if the fifth wave doesn't fail. If the fifth wave does fail, it's probably just as weak. And a fifth wave extension terminal probably to be the least counter trend weak, even though it still should be followed by complete retracement about 50% of the time. The first wave will probably be about 25% of the time. The third could be between 25 and 50, and a fifth wave extension terminal will probably be around 50%. But they're all going to be completely retraced in less time, probably about 50% or less.
Right, okay.
How do you adjust the 0B trend line at the end of a pattern finishes higher than? Okay, if you have a 0B trend line, but the B wave finishes after the touch of the trend line, that's fine. You don't adjust the channel. You keep the channel the way it is, but you just move the label of wave B to the slightly higher low. If the channel is going up and it touches at 100, but the B wave finishes at 105, you just put the B wave at 105, but you keep the channel the same.
Doesn't that cut through the trend line? Say you've got a zigzag and B and higher up, so when you draw the 0B trend line, doesn't that mean that the trend line is going to cut through the low.
No, you don't move the channel to touch the end of wave B. The channel should be a clean line from 0 all the way until the end of wave C. So it should only be touched one time. Okay.
Right.
If the B wave finishes after the touch to the right and higher, that's fine, but you don't readjust the channel to go where the B wave finished. You keep it where it touched the point to the furthest right possible data point, even if the B wave finishes higher and later.
Right.
Okay. Does that not make sense?
Well, I tried to send this email over to you that shows my chart.
If you have this and you thought that was the B wave, this tells you it's not, right? So you would adjust the channel and go here. The B wave eventually.
What if there's a slight adjustment though? That's obviously, you know, where you've got, B comes
I'm
down.
going to show you right now. I diagram the situation for you right now. Okay, so let's say the B wave, technically, I don't want to have it so high up, hold on. Say technically the B wave finished there. You're not going to do this. You're going to keep it there. That's your question, right?
Yeah.
Okay, that's it. You want a clean line, not broken at all. It should be touched one time, and that's it. Wherever the B wave finishes is irrelevant. Where it touches should only touch one time, and that's it.
Right. Okay.
And the parallel is going to be parallel to that line. Okay.
Right. Okay.
Okay. Hopefully I'm not going to mess anything up doing this. Okay, let me redraw that. Go back to the questions. Okay, this is a really long question. Should never take more time than ABC. That's correct. That would indicate it's not an X wave, but it's a B wave or some other wave.
Right.
And you don't want it to be more complicated either. For it to be an X wave, if it's smaller, it needs to be 61% or less. If it's larger, it needs to be about 138% to 161%. It should not be 261% of the previous pattern. That's too big. Okay, so if it's that big, it's probably a running B wave, and what you thought was an ABC is just wave A, and this would be wave B. So somewhere in the 138% range would be perfect for an X wave if it's bigger than the previous ABC. And this should not apply to an X wave. Okay.
Right. Okay. Is it possible to project the time length for X waves in a pattern?
It should not be more time consuming than the previous ABC.
Right. Okay.
It should be more than a third, not more than 100.
Right. Okay.
A pattern looks like a 5-wave move. It lacks alternation. What does it mean? Probably it's a double zigzag or complex corrective rally, or you're missing a wave. Very frequently, you're missing a wave. So you might have some examples here. It's just probably missing a wave somewhere, or it's a double zigzag. So what you think is 2 and 4 is really a B wave and an X wave, or a B wave and another B wave, and there's an X wave missing in between. But that's what it means. You don't want to have identical behavior between 2 and 4.
Yeah.
In regards to minimum wave C and B wave running correction, you want wave C to be at least 61% of wave A in that kind of situation. Be very unusual for it to be less than that. It could be 100%, it could be 161%, but it should not be less than 61%. Otherwise, you're probably dealing with something else. The stronger the B wave is, the more similar A and C should be. Remember, it's always that rule of differences and similarities. So the more different one wave is from the next, the more likely the other one's going to be more similar, or half of the other two added together. So the bigger the B wave gets, the more C and A will be similar in price, but different in time because the B wave is a lot bigger in time. The more A and B are similar in time and price, the more wave C is going to be different in time and price. So it's always that balance, a yin and yang between the three elements.
Right. So when you do get a running B correction, C needs to be a minimum 161% of wave A.
No, it needs to be 61% of wave A, but it's probably going to be 100%. The bigger wave B is in price, the more C will be equal to wave A in price. But it can't be time because A and B are going to be very different in time if B is a lot bigger than wave A, right? So most likely you're dealing with A plus B divided by D for time, but A and C will be very similar in price if the B wave is a lot bigger in price.
Is this the following? Is this the C wave that comes after the running correction?
No, this is the C wave of the running correction.
Of the running correction, right? Okay. But the C wave after the running correction has to be.
Oh, the C wave after the running correction has nothing to do with the ABC. It has to do with the A wave before the ABC correction. So you have the big A, the ABC running correction for wave B. The A wave, the big A wave is the one you're going to use to project the C wave, which will be minimum the length of wave A, but most likely 161% of wave A, maybe even more.
Right. Okay.
Okay. It's a lot bigger than that. Most likely you're dealing with a 1, 2, 3, not an ABC situation, because you don't want a C wave to only be more than about 161% of wave A. Otherwise, it's more likely to be a 1, 2, 3, not an ABC.
Right. Okay.
Okay. Where are flats constructed? I'm not sure what this question means.
Where do you normally find these structures in a pattern? For example, you'd find a flat in, say, you can find flats in a, say, a zigzag B wave of a zigzag.
I wouldn't try to make those kind of rules. You know, they occur where they're allowed to occur, and so if it's a corrective phase, it can be any one of those that you have in the list. If it's an impulsive pattern, it can't be any one of those in the list.
Right. Okay.
I wouldn't do it that way. Okay, an elongated flat occurring else. Pretty much no. Elongated flats typically happen in triangles and possibly in diametric patterns, and that's pretty much it.
Right. Okay.
Okay, what's the maximum length of wave C? Generally about 161%. As I said earlier, if it starts to move to 200, 250, 260%, you're probably dealing with a 1, 2, 3, not an ABC.
I think that meant within the running correction, within the C wave of that correction.
The C wave in a running correction should not be more than 161% of the A wave of the running correction and no less than 61%. So somewhere between 61 and 161. But the bigger the B wave is, the more A and C will be equal in price.
Right. Okay.
What's the maximum length B wave can be in a running triangle? Probably around 161% of wave A. Less is better, but that would be about the maximum. But then you're going to have wave C about 61% of wave A, which is going to, you know, it's going to move the trend up quite a bit, but it is possible. That would be about the most I would allow for.
Right. Okay.
How do you divide the daily high? We've already gone through that.
Yeah.
Okay, so
that's
go ahead and remove this. Let me get to Martin's question. Let's see. So let's see, Martin. I guess this is the monthly. I'm not sure.
Yeah, it's monthly.
Okay, so what are you asking about this? Oh, this can't be impulsive because the retracement's too big.
Yeah, that was my question because it's 2/3 retrace the 5-wave move. So
Right.
I wasn't sure if that's possible.
Yeah, no, it's too big. You would want this to have stopped around 61%. So it's too large. So this would be a 3 and this would be a 3. And this is a pretty good structure for a flat. Violent A wave, slower, you know, severe retracement by wave B, and then wave C looks more violent again, but it's going to take the time of equal of A plus B divided by 2, and A plus B's complexity divided by 2. So 3 here, 5 there, a total of A divided by 2. So you can't have 4 waves, so it's got to be 3 or 5. So wave 3 would be 3 or 5 waves back up into this region. That's probably what will happen next.
Okay. Yeah, the other picture was only the 5-day from this pattern. And there I thought it's the 5-wave move with the flat and the X wave.
Starting way over here.
Yeah, that's
Okay,
the
so
starting point of the Wynand move.
let's see. Okay, the retracement is right at 61%. It took a little longer than you would normally expect, but let me measure the time of wave one. Actually, it's only about not even quite twice. So this looks good. So this could be a wave one, this could be a wave two. The third wave, you'd have to assume there's a missing wave because all you see is this correction near the upper end. So there's probably a 1-2 that you missed down here to create a 5-wave move, which is fine. Wave one was a mono wave, so this could have been fully developed or partially developed. This would be an example of a missing wave situation, most likely. This correction is much larger than this and more time consuming. This could qualify as wave four. You can see it takes less time than this. Retracement wise, this is around 38, this is around 61, so there's good alternation with that. And then the fifth wave would be similar, let's see. Looks like wave five might be a little bit bigger. So wave five is right around 161% of wave one. So you draw your 2-4 trend line in, parallel is not going to be a great parallel. It's a little weird actually. There is no parallel to draw. You could draw another channel across 1 and 3, but it's very strange actually. Normally you'd have a parallel to this and that doesn't really work very well. The breakdown, let me check that. I'm gonna get a ruler thing out here. Yeah, so we would get stage one confirmation right around here where it broke the 2-4 trend line the same time or less, same complexity or less. I don't know if it fully retraced it. Let's see. Yeah, it looks like it, well, it's a close call, isn't it? Let's see how long this takes. I mean, it's a really close call. It looks like almost right at the point where it broke here was the same amount of time from here to here as from there to there. So I'd say it probably qualifies as phase one and phase two confirmation. So probably a 5-wave move finish here, but the problem is you then retrace too much of the 5-wave move. If you make this a 5-wave move, you would compress it into colon 5, and then that move got retraced more than 61% with this decline here. So this would have had to be the end of some larger 5-wave move and compressed into, you know, a much larger move that's either a 3 or a 5 itself. This tells you that there must have been more action that occurred over here because this is a very long drawn out kind of correction to a very simple kind of quick move. So most likely this was the end of a zigzag or the end of a 5-wave move. And this would be wave one or wave A of something. And this would be wave B finishing, not even sure if it's finished based on the way it's behaving. It's not advancing very quickly. This drop is bigger than 61% of this rally. So I don't even think the correction is over yet. It's getting a little complicated. We're probably pushing 55 mono waves here. So you want to move this to a larger time frame, figure out what that's doing to help you count this. But what you're missing is what happened over here to figure out how to compress this and how this relates to that. But this does look like a 5-wave move based on behavior and everything else.
Yeah, this chart is first Wynand move from the monthly chart. You opened first.
Oh, is it starting from that recent low?
Yes.
Okay, well then you'd have to, if this is the rally that you're talking about, future price action prove that this is not impulsive, even though it looked like it was impulsive initially. So let's see, I don't think I can see it on the chart. But... So based on the big picture, you wouldn't have even started off with the assumptions that I made there. You would have seen this move up, and based on it getting retraced too much, you would have known it's not starting a major new trend because it's getting retraced too much. Even if you had thought it might be a 5-wave move initially, based on what the monthly charts are doing, it's forcing you to change your count. So this would become a 3, it would be wave A. This would be a 3 for wave B. And that means your daily chart would have to be an A and a B, and I don't even know if the B wave's over yet. The monthly chart suggests that probably it is, so I would count it as if it is, and you'd have to figure out where to terminate it, probably somewhere in this area where you got the violent move up. So maybe this is where the C wave began, but based on its current behavior, it's, well, this is right at 61% retracement of the move from here. So maybe this almost looks like a terminal pattern because this is not impulsive, that's for sure. So maybe this is a corrective wave 1. We might be in wave 2 in here. I don't know exactly, but that's the process that you have to go through, and you have to be very meticulous about all this. You also want to know what this is, and it doesn't start from the small time frames. Everyone always tries to do that. They want to start small and build up. You need to start large and work your way down. So you want to start with the longest possible time frame. If this is it, then this is clearly a corrective rally. This is clearly wave A of something. This is clearly wave B of something. And then within that B wave, this would be wave A of something, probably in wave B of something, but I don't see anything significant enough to predict that the market's going to rally a lot. It looks like it's just still correcting since this high, and it could just meander around until something significant starts to the upside that begins to mimic this behavior. We have yet to see it though.
Okay, thank you very much.
Okay. Close all those charts. Okay, we're really, we're about 30 minutes past our normal time, so I don't really know if we can go through all these other charts, but yeah, Hamid, you asked a lot of questions. I think we may have to cut off here, and I can possibly take a look at these later, but why don't we call it a day here, and I want to thank everyone for taking the class. Hopefully it's helped out a lot and helped you become a better wave analyst. Remember, if your focus is better, if you want to make money trading, this is only useful at extremes. If you want to make money trading, the river class is definitely the better way to go. If you're looking to predict markets better, then the wave class is definitely the way to go. Now, I think this is the group that was taking the introductory class. So if you want to move on to more advanced wave analysis, you can talk to Magellan about that. We do have a class starting, I think, the 31st next week, I think, which will actually show all this stuff applied in real time, starting from a large time frame on the S&P, and then on gold, and then T-notes, and then the euro currency, and eventually probably Bitcoin, and working our way down from the highest time frame down to the lowest time frame, not the other way around, to show you the proper way to do analysis and to do forecasting in real time. And every week we follow up with whatever we predicted and what we expected and see how it unfolded. I could show you some charts of stuff we've done just recently. A lot of it is, panning out as expected. Let's see. Now, I haven't had a wave class in a while, so a lot of these charts, oh, it's the wrong list. Don't know if I'm sharing that data. Let me see, hold on. Shared Excel main. So shared. Excel main. Okay, see, these are my up-to-date charts. Let's see. I'm just going to open up the S&P charts first, just so you can see them. Because on those charts, if you get my forecasting service, I sort of map out what I think is going to happen based on price time parameters and minimum maximum links, and taking the speed of a previous move and adding that price time to a next move, so you get an idea of what's supposed to happen. That's all the kind of stuff that we're doing to make sure things are staying on track. Like here's an example in 6 monthly. Yeah, 6 monthly high or half yearly chart. So it's the highs and lows of every half year. And here I'm taking the time of A plus B plus C from high to low. That should be the maximum time allowed for the D wave. So you can see based on this time, which is identical to this, it's just a little bit more vertical price-wise, but time-wise is exactly the same. You can see we only have about 6. This just started, so we only have about this year to finish, because this 6-month period and then one more. So through the end of this year, then we're going to run out of time. So sometime before this year is over, this D wave, if this count is correct, should be coming to an end. And when that comes to an end, then we can begin what should be a really nice decline. Now this looks bigger than wave A, but price-wise is exactly the same. So horizontally, it's the exact same price. Vertically, it's the exact same price. Horizontally, it's very different in time because I'm taking the time of wave A and wave C, and taking the time of wave C and wave D and projecting out about how long the E wave will take, taking half of those times, and that projects somewhere right around in here, which is, that's 3 years, so 2023, maybe around 2025 approximately is when this would be bottoming and coming back toward this old high and retracing about 61% of the C wave itself because this D wave is corrective. So this is the ultimate eventual target after the D wave is over, and that's how that was done on that chart. Of course, that move hasn't happened yet. Let's see, on the monthly chart, you can see where at least in my service, I was taking the price and time of this prior D wave. This would normally be a good projection because the pattern's drifting upward, and this was a counter trend corrective rally against the downtrend. So I just took the length of wave D, added it to this low, which gets us this target, and then I connect those two with a straight line because this is the ultimate price time target. So this is approximately how fast it should advance, and it's remarkably been doing this now for months and months. It's just a little bit behind. The minimum thrust out of a neutral triangle is around 75%. So here's the 75% level. We have reached that. So it is possible the thrust is pretty much over, but we still have a little more time to go. So it may just meander around. I don't know. I don't know if it's going to accelerate and go up or it's just going to meander, but either way, it's done pretty much what it was required to do. The thrust out of this triangle, this was really interesting because remember the contracting triangle has a little bit more specific and rigid kind of requirements. But you can see here's the B wave, the biggest wave of the contracting triangle. This should be the minimum price time move. You have to reach the target right at the right time. And that's how we knew that the contracting triangle was over and that we were now in a much bigger uptrend. So when I knew we were in the much bigger uptrend, then I could take the next projection, which was that, other chart. I may have closed it already. I think I closed it, but that's where I got the bigger projection on the monthly chart, saying that, once the contracting triangle was confirmed, they don't pretty much confirm the entire structure of everything. So I could be fairly confident that we were going to get a breakout of the bigger move too. Let me see if I can reopen that chart. I think that was a monthly chart, right? It's not opening. Let's see. It should open here in a second. The hell is it? I don't know why it's not opening. I don't see it. A little weird. But if you remember that blue rectangle I had starting from the bottom of D to the top of D and added it to this point here. So I was measuring on more, or maybe this is it. This is definitely, this is it here. So we had the contracting triangle, which confirmed because this move was equal to, or this move was equal to that move. So then I knew the contracting triangle was over, the thrust has started. So this contracting triangle was correct. It had to be the end of this bigger neutral triangle, which had to be finished. So then the next advance would be potentially as big as this D wave of at least 75%. So I took 75%. You can see we're keeping up with that. As far as the D wave, we may or may not keep up with that. We're just going to have to find out. But to do it, it's going to have to accelerate quite a bit. And of course, to do that, it's going to have to, do that. So it's possible, but we have almost reached the minimum target on a log scale. The other chart was an arithmetic scale, and it's already reached it. But on a log scale, we're not quite there yet. So we probably have a little bit more to go before we've reached minimum upside potential. And we still have a little more time to go. So a month, month and a half, something like that. So that gives you an example or an idea of what we do during class and how all that's done to make projections for the future. So anyway, you just let Magellan know if you have any interest in either the more advanced wave class, you want to take the trading class, and we can let you join in on one of those classes. They start next week. If you don't take next week, I think it may take a month or 2 or 3 before you can start again. Okay, well, thanks everyone. I appreciate it. And I'll try to get to any questions in the customer service account or in my, my main email if I can. But I appreciate it, and hopefully y'all enjoyed it, and I will hopefully hear from you soon. Have a good one.